Okay, I think we will go ahead and get started. We might have a couple other people popping in here, but it's 9 o'clock, so we'll get started. I know Chris has a nice full slide deck to get through today. So I just want to say good morning and welcome everybody to Stark Community Foundation's investment update. I'm Carrie Bass, the CFO for Stark Community Foundation. And it really is my pleasure today to introduce to you Chris Caparelli of Marquette Associates. Marquette Associates is our investment consulting firm. Chris is a managing partner with the firm, and he brings over 13 years of investment experience with a strong focus in the nonprofit area. So today he plans to discuss current market conditions and the overall strategy for Stark Community Foundation's investment portfolio. So we're really excited today to be able to share Chris and Marquette's expertise with you. So again, I thank you all for joining us. We have up until 10 o'clock, and like I said, he's got a nice thorough slide deck, so we look forward to it. And if I could share just a few quick housekeeping items before we get started. By default, the video and audio for all attendees has been turned off. If you do have a question for Chris, we ask that you submit it through the chat feature, and we will do our best to monitor that and address those questions as time is available. So with that, again, I thank you for joining us today and for your relationship with Stark Community Foundation, and I will turn it over to Chris Caparelli with Marquette Associates.
All right, well, thank you, Carrie, and nice to speak with you all, even though I can't see all your faces. Hopefully at some point in the future, we'll be able to do this again in person, but I hope everybody's well and staying healthy and all that good stuff. So yeah, it's been, planned to spend about 45 minutes or so this morning, sort of talking through the market environment and, the work that we've been doing with the Community Foundation. As a firm, Marquette has been lucky enough to partner with the Community Foundation for about 3 years now, and we've really enjoyed the relationship and think we've been able to do some pretty good work together, working with Carrie, staff, the Investment Review Committee, and the board. So before I get going and kind of dive into the market stuff, just wanted to give you just a quick update on who we are at Marquette. Not necessarily a household name, but we are one of the, I guess, mid-sized players within the investment consulting industry. You can think of us like an investment advisor for an individual, except we primarily do that work for institutions. So today we have around 340 billion in assets under advisement. That's spread across about 450 different organizations, both in the nonprofit space, the public pension fund space, the Taft-Hartley or union space, and then along with healthcare, private clients, and some corporate funds. We are 100% employee owned. We have 120 employees, and that puts us again as about the 20th largest consulting firm in the country. So we like to think that's big enough to give us the size and scale to have all the resources of the larger firms, but not too big where our clients sort of get lost in the shuffle. We are lucky enough to work with some really outstanding organizations. A handful of these clients here are groups that I work with personally. Others are, serviced by other consultants around the firm. But hopefully there's some names that you all recognize on this list. And, we're really fortunate to feel that we can be a part of these organizations, help them grow their asset bases and further the mission that all these groups are trying to put forward. I think our structure is really important, and it gives us, I guess a little bit of a differentiator and maybe some advantages over other organizations or other groups that do this out in the industry. And the biggest factor is that we are independent. So by being employee owned and by being independent, we are beholden only to each other as other partners around the organization and to our clients. There's no formal relationships that we have with banks or asset managers or broker dealers. So we have no kind of ulterior motives or no other ways that we collect fees or collect revenues other than kind of the hard dollars that our clients pay us for our advisory services. We think it keeps it a pretty clean business. And while our recommendations, unfortunately, are not always going to be right, I think what's nice and comforting for our clients to know that, when we make recommendations as far as building portfolios, that's sort of the best information and advice we have at that point in time. And you don't have to worry about any other conflicts of interest. So we think it's sort of the right way to help our clients build portfolios and manage money. That allows us to sort of align our mission with our clients. So we've got the mission statement of the Community Foundation along with Marquette here on this slide. And I think they kind of work together nicely to become really an extension of your organization, an extension of the Community Foundation to help, again, grow those assets and further that mission. If you had to kind of boil down what we do into three words, we think that the three are build high quality portfolios, manage risks, and maintain costs at a pretty low level. We do a number of different activities kind of under those three bullet points. But if we think about managing risk, it comes to more than just the statistical versions of risk. That's building an investment policy statement that has really good structure and good guidelines around it, building a strong asset allocation that we can feel comfortable with at the overall portfolio, and then doing things like education, making sure that when we make recommendations to put in portfolios, it's something that the entire kind of investment review committee and board can feel comfortable with, and it's not just something that we're sort of recommending for the portfolio without that partnership approach. On the quality side, we believe once a portfolio is built, we can't just sort of set it and forget it. It takes a lot of work to maintain a total portfolio. There's a lot of moving parts. There's always different pieces in the investment management universe that are moving around and changing with combinations and people leaving. So it's a pretty significant due diligence effort. And then, again, our goal is to be a long-term partner with our clients. And that involves things like negotiating fees, keeping costs low, building an efficient portfolio to really monitor and manage that entire investment program. So that's about it on Marquette. Just wanted to give you a quick update on who we are and some of the work that we do. From here, kind of in this next section, I thought I'd spend a little bit of time talking about the portfolio that we have built together with the Investment Review Committee, and I'll give you a little bit of an update on how that process has been going over the last couple of years. So, if we can boil down all of the parts that go into building a portfolio and maintaining a program into a few sort of key or core functions, we think probably one of the most important is the overall asset allocation that we build for a portfolio. And when I say asset allocation, I mean sort of the decision between how much of the overall pool of assets to invest in various sectors of the market. So how much to invest in the bond market, how much to invest in the stock market, so on and so forth. That has statistically been shown to be the biggest driver or most important determinant of risk and return going forward. There's a lot of other parts that are involved in managing a portfolio, things like rebalancing, timing, moving money around, security selection. But at the end of the day, we think the most important and sort of the biggest piece of the process is the asset allocation work. And that's what we really spend a lot of time on upfront. That work has, without a doubt, gotten more challenging over the last 10, 15, 20 years. And the biggest reason and the biggest determinant for that is the interest rate environment that we are in. So this here is a chart of the yield on the 10-year Treasury bond, so just the U.S. 10-year Treasury going back to 1962. And you can see from kind of 1962 through the mid-'80s, interest rates were steadily climbing up to sort of that peak of around 16% or so. And then since that point in time, as interest rates have been falling, it's been a pretty easy environment, certainly on the fixed income side of things, to make money and earn pretty good rates of return in the portfolio. If you think back to the 1980s, you could buy a 10-year Treasury bond that was paying 14 or 15%. And as interest rates declined, you earned some additional premium for holding those bonds with rates rising. Unfortunately, in the environment that we're in today, over on the right-hand side of the chart, interest rates are awfully low. And that makes that work, again, of building portfolios to achieve a return of 7, 7.5, 7.75, more and more difficult, because a 10-year Treasury bond only pays you about 1.5, 1.6%. So we can't rely on high quality, safe, secure government bonds to generate too much of our portfolio return. This is reflected in the asset allocation work that we do. So we have a pretty robust asset allocation model that factors in all of the available historical data, runs simulations, and then projects asset class returns going forward. And if we think about just 10 years ago, so coming out of the financial crisis back to December of 2010, when the economy was really starting to take off after the sort of the depths of the financial crisis, that software was telling us that over the next 10 years, so from 2010 to 2020, you could probably earn around 10.5% from equities, and you could earn around 4.8%, almost 5% from fixed income. So if you think about a traditional 60-40 portfolio, sort of the classic portfolio construction of 60% in equities, 40% in fixed income, by putting 10.5 and 4.8 together in that combination, you could earn a pretty good rate of return over the last 10 years. And that's exactly what we've seen. The last 10 years have been a really good environment to make money, both in stocks and in bonds and a lot of other asset classes. Fast forward that to today, and we look at what our model tells us over the next 10 years, and those numbers are quite a bit lower. So the equity return, or the return that we expect from the stock market, is down to about 7.5 today, pretty close to the long-term average. But the, I guess, more concerning piece is that fixed income component, the bond part of the portfolio, is only expected to earn a little less than 2%. So not nearly sort of the projected return stream that we've seen kind of over the last 10 years. What that does is that forces organizations like ourselves that build portfolios for institutional clients to take on more risk. So a pretty popular rate of return within the overall sort of nonprofit space, even in the public pension fund or private pension fund space, is to hit a rate of return of around 7.5%. And the way we get to that number is most organizations have about a 5% spending policy. So they need to spend about 5% of the portfolio every year. And then inflation, averaging maybe 2% on top of that, and throw in some fees, and that gets you to that sort of 7.5 rate of return target. Before the financial crisis back in 2007, if you use just sort of publicly available liquid asset classes like the U.S. equity market, the non-U.S. equity market, the bond market, high yield bonds, you could have built a portfolio that was projected to hit 7.5%. With a pretty conservative structure, having about 35% of that overall portfolio in fixed income. So something that sort of looks like that classic 60-40 portfolio construction. Because of the interest rate environment that we're in today, with interest rates really low across the curve, that has forced organizations across the board to take on more risk. So in order to build a portfolio that now is projected to earn 7.5%, you have to take on about twice as much risk in the portfolio than you would have kind of 10 or 15 years ago. And that's just a reality of the environment that we live in today. So if we think about sort of portfolio building blocks and kind of as it relates to the Stark Community Foundation, here we have a portfolio return target of 7.75%. That's the dotted line that sort of goes across the middle of the chart. Plotted on the X and Y axis are risk and return projections for a various number of asset classes. And what you'll see here is that a lot of the asset classes that we have in the portfolio today are not projected to hit that 7.75 rate of return on their own. So something like high quality core fixed income that's down in the lower left-hand part of the chart, only projected to return 2%. So if we know we need to hit 7.5 or 7.75 or even 8%, we have to think about asset classes in this upper part of the chart, things like private equity, things like private credit, asset classes that contain a fair amount of risk in order to get to that overall return target. So I guess the point I'm trying to make is that institutions across the board have had to take on a lot more risk over the last 10 years in order to achieve the return targets that were once achievable with a much more conservative portfolio. And that's, again, because of the interest rate environment that we live in today. So how have we recommended that the portfolio change to sort of correspond to this environment that we live in? If we look back just a couple years ago to the asset allocation in the middle of the summer of 2019 versus the asset allocation that we have worked with the committee to put in place this summer, there have been a couple marked changes. And the biggest one probably is more illiquidity and more risk in the portfolio. So back in 2019, private equity, which is one of the asset classes that expected to achieve the highest rate of return, had a target of around 7%. Today, that number is 10% plus another 5% for private credit, meaning we have about 15% of the portfolio in illiquid asset classes, riskier asset classes than we had 5, 10, 15 years ago. One of the other changes would be more real assets, so real estate and asset classes like infrastructure. And then probably the other biggest change would be a reduction in public equities. The public equity market has been fantastic over the last 10, 12 years. But certainly the rates of return that we've been seeing, we don't necessarily expect to continue. And that's where a lot of volatility comes into the portfolio. So that's an area that we've started to dial back a little bit in favor of real assets, or real estate, and some illiquid parts of the portfolio like private equity. So this is kind of how the portfolio has changed over the last couple of years. And we're always thinking about how markets are going to change going forward and how these segments of the portfolio will continue to evolve. So once we've sort of set that asset allocation, we then write that into the investment policy statement. That, I guess, for lack of a better word, is sort of the Bible, the investing Bible that we work off of, and really helps keep everybody on the same page in times of market crisis. We don't spend a whole lot of time looking at the investment policy in a year like 2017, when the equity market just goes up every single month. But in a year like 2020, when we're hit with a severe recession right out of the gates due to COVID, the policy becomes really important, and we kind of look to that for guidance as asset classes and markets are moving dramatically in a lot of different directions. And this sort of asset allocation that we've built is memorialized in the investment policy statement with rebalancing ranges around the targets. So from there, I mentioned, asset allocation we think is the most important part of the process, but it's certainly not the only part of the process. That decision of how much to invest in various asset classes is really important. But at the end of the day, because we are not an investment manager, our job is to then go out and find the best of breed investment managers across the really world or country to then go out and execute the individual mandates that they've been assigned. So our research team here at Marquette goes through a pretty thorough sort of 4-phase due diligence process to whittle down the universe of tens of thousands of asset managers out there to the maybe few hundred that we really think are best of breed within their individual asset classes, and we feel comfortable recommending that our clients place capital with. So that includes things like filling out a full firm RFP, on-site visits, which have gotten more challenging in this COVID environment, but really getting to know the firms that we partner with and recommend that our clients invest their hard-earned capital into. There's no, in our minds, silver bullet for identifying high-quality investment managers. It just takes a lot of meetings. So if you look across 2020, our staff here at Marquette Associates conducted over 3,500 meetings with asset managers across the entire spectrum of various asset classes. And it takes that work for us to, again, feel comfortable with these groups and recommend that our clients invest their capital. So what that looks like, there's obviously tens of thousands of asset managers out there. Our portfolio contains about 20, 25 different groups. And I've just kind of highlighted a couple names here of managers that today the foundation portfolio works with. Hopefully, some of these names are household firms for you all. So a group like BlackRock, they are the largest asset manager in the world with over $10 trillion in assets today. And certainly we have some investments with BlackRock across a couple of different index funds. Other household names on the list like JP Morgan. We've got a private equity portfolio with JP Morgan, along with an infrastructure portfolio managed by JP Morgan. But there's also some names on here that are hopefully boutiques and hopefully are names that you guys don't recognize. And I think that's part of the work we do to not only find the largest investment managers, but also find the small boutiques that are really good at one specific thing and really good at one thing that they do. So in the bottom left-hand corner, a group called Parametric. They're based out of Minneapolis. They are experts in the sort of options portion of the market. They run a sort of hedged portfolio for the community foundation, and they do so, again, with a lot of expertise, and is probably a name that you don't know. Or a group like Octagon. They're based in New York. They're a bank loan manager. They're a CLO manager, and maybe not necessarily a household name. You also see a few names on the list that hopefully are familiar in the local market. So a group like Beast Fulmer and a group like Huntington Bank. Certainly, as a community foundation, there's some desire to keep assets within the local market. And that's certainly something that the group has done over time to keep some dollars at home in Ohio. So this is just a snapshot of some of the groups that we work with today. Not a comprehensive list, but again, some household names, some maybe smaller boutiques that go out and execute on that asset allocation strategy that we put together. So wrapping it all up, the asset allocation plus the manager selection turns into performance. At the end of the day, this is a performance-based business, and performance is important. It's the main metric that we are evaluated on. And I think that the track record that we've built over the last few years, and certainly the longer-term track record that the committee has built, is one I think everyone can be proud of. So if we look out to the longer term, 10-year time frame, the portfolio has been compounding at almost 9% per year over the last 10 years. That's a rate of return probably higher than we would have expected 10 years ago, but certainly coming out of the financial crisis, it's been a pretty good environment to be investing. And then over the shorter term, if you look sort of year to date, 1 year, 3 year, for the last 12 months, for example, the portfolio is up 25.9%. This is a good reminder of why we don't necessarily try to time markets. If we think about what happened in early 2020, we came into the year with a lot of good expectations, and right out of the gate, we were met with a global pandemic that changed most facets of our daily lives. And sort of knowing that information going into 2020, we probably would have sold all of our stocks and tried to sell more on the way out. But the exact opposite happened. The Fed started to intervene, and we saw a lot of stimulus into the economy, and equity markets and really risk markets across the board have been off to the races over the last 12 months, over the last 18 months. And the portfolio has certainly been a beneficiary of that, returning again more than 25% over the last 12 months. So it's a track record we're pretty proud of, and a track record that I think demonstrates a commitment to investing the assets the right way and growing the corpus of the foundation. So obviously performance is important versus the benchmarks that we set for ourselves, but it's also interesting to note sort of how the foundation does compared to other endowments and foundations in the overall universe. We use a software provider called Investment Metrics. It has 40 other consulting firms on the platform. There are over $5 trillion in assets on the platform. So it's a pretty good, robust universe for us to draw comparisons to. And from time to time, we like to keep an eye on how the community foundation is performing versus other nonprofits in the space. And here's where we think certainly over the short term and medium term, the performance stacks up pretty well. And these are numbers that we want to keep an eye on, as obviously we all know that there are sort of competing sources for charitable dollars. So this is important to us and something we want to monitor and certainly continue to improve over time. One more comment on sort of peers and how our peers are performing. We know that from time to time, sometimes we'll be doing better than the peers, sometimes we won't be doing as good as the peers. And the reason is we're not invested exactly like our peers. Now, there's certainly some commonalities across the way this portfolio is invested versus the way the overall universe is invested. We all see the same data points. We all see that fixed income is not going to be a driver of return going forward. And as a result, we have all been reducing the component of fixed income. But we certainly don't make the same recommendations across the entire universe as our peer groups. And we certainly have some differences as to the way that this portfolio is invested versus the way the peer group is invested. So for example, if you look at this first box here, total equity, it shows that across the entire universe of nonprofits, there are some groups that have about 80% of their portfolio invested in stocks. There are some groups that only have about 30% of the portfolio invested in stocks, yet the median allocation has right around 60%. And today, the Stark Community Foundation is a little underweight equities at around 55% or so. So a couple takeaways from this chart, a little bit underweight equities, a little bit underweight alternatives, and the offsets would be overweights to real estate, real assets, and private markets. And this will drive performance and discrepancies in performance between the community foundation and the peer group. One thing I like to say is that we certainly, there is certainly some wisdom in crowds. We don't necessarily want to be always invested exactly like our peers, but to the extent that we have differences from the peers, we should probably have a good sort of foundation or reason for it. And that will sort of drive performance going forward. So that is the performance update and the asset allocation update on the community foundation. From here, I thought I'd spend the next kind of 15, 20 minutes or so talking through the market environment. we are in a pretty remarkable time for a number of reasons. Certainly the post-financial crisis world, going back to 2008, has been probably a lot different than anyone would have expected. And I guess I don't want to say post-COVID world because we are still seemingly in the midst of the pandemic, but the beginning of the pandemic timeframe has probably been different than anyone would have expected. And that informs our decisions on how we build portfolios and how we think about asset classes going forward. So I thought I would just talk you through kind of some of our thinking as it relates to the market that we're in today. So if we think about sort of how this pandemic how it began and how it has shaped and how it has affected our lives, it's certainly been probably a longer running thing than we would have expected, and certainly may be here for some point in time still. And I think this will continue to be a big headline and drive returns and performance until we're on whatever the other side of this environment looks like. The latest issue has been the Delta variant. I'm sure there are probably going to be more variants to come. But the Delta variant certainly put a little bit of a damper on economic expectations. If we think back to the spring of this year or even the summer of this year, all of the curves around the country were moving in the right direction. I remember back to the 4th of July holiday, it seemed like certainly here in Illinois, everybody was out and about and celebrating in a pretty normal way. Pretty low virus counts around the country, around the state, around the city of Chicago. And I think everyone was feeling good about the future path of the virus. Then we saw the Delta variant spike, and that certainly put a little bit of a dent in the economic expectations going forward. So what I mean by that is projected growth rate, so overall GDP growth in the United States. We show a number of different kind of regions of the world here, but if you focus on just this middle section, which is the US, we obviously saw GDP sort of fall off a cliff in 2020 with, everyone working from home and, changing our consumption patterns. And then on the flip side, as we turned into 2021, the expectations for growth were pretty robust. So the U.S. economy is expected to grow at around 6.5% this year, which will be one of the fastest rates of growth that we've seen in the last 30 or 40 years as we rebound from the pandemic. That expectation is what was dented a little bit by the Delta variant. So if we look at expectations for U.S. growth back in the spring versus where things were closer to the fall, those numbers are starting to come down around the world. And that is primarily the result of the Delta variant and how the pandemic has continued to shape our lives and really be a pretty significant driving impact on markets going forward. One of the big topics out there today is inflation. We really haven't seen much in the way of inflation for quite some time now. So if you think back to the financial crisis with the amount of stimulus that was pumped into the economy, the classical school of monetary economics would suggest with that much money printing, inflation should follow. And in the 10 years after the financial crisis, we really never saw it. Inflation stayed sort of well below the Fed's 2% target for a long period of time, sort of baffling a lot of kind of classical economists. That has begun to change over the last couple of quarters. So we see this CPI, Consumer Price Index, year over year, which was hanging out right around 2% or below, begin to move up here pretty dramatically this spring. And I think that there's a couple of different schools of thought here. One is that, at least from the Fed standpoint, this inflation is transitory, and certainly a lot of economists would agree, and that forecasted inflation is expected to come back down. So I don't think anyone's thinking that we're going to have sustained inflation of 5-6% year in and year out. But if you look at where this line is expected to come down to, it probably doesn't go down as far as inflation once was. So I do think that transitory thought from the Fed may last a little bit longer, and we may have higher levels of inflation for sort of that short to medium term than we've seen over the last few years. Certainly some drivers of this inflation are subsiding, and there's a lot of this that is just due to supply constraints and other sort of weird issues that this pandemic has caused. So if we look here at inflation for used cars, housing, and lumber prices, all three sort of popped up at various points over the last year or so. Thankfully, some of the inputs like lumber has come back down. pricing for used cars has sort of turned a corner here, but we still see the price for housing moving up pretty dramatically. In that, it's amazing how the pandemic changed the story. If we think back, just 3 or 4 years ago, the story was that millennials were not going to leave cities. We're going to raise their families in cities and not move out to the suburbs. And then, today, as a result, home builders didn't build much. And then today, where we have this sort of flight out to the suburbs and the exurbs, we're seeing home prices move in a much different direction with some pretty significant supply constraints. So I guess the point is here, we think a lot of these factors will sort of work themselves out. Once the chip shortages are, come back into play, the cars will normalize, used car prices will normalize. But there are going to be some factors that sort of drive inflation that are going to take a while to change. And the biggest is the labor market. There remains a pretty significant labor shortage. If you look, you don't have to look too far to see help wanted signs across really the entirety of the economy. I know the grocery store by my house has full-time, part-time, and it says anytime they're looking for workers. And this is part of the inflation that is likely to persist. So if you think about how that works into inflation, wage prices, once wages move up from $10 an hour to $15 an hour to $21 an hour that I think Amazon is offering in some of its facilities, those wage increases are awfully hard to roll back, and those wage increases are oftentimes passed on directly to us as consumers. So I think, some of the strange inflation that we've been seeing over the last year or so, like lumber prices and used car prices, that will subside and that will normalize. But to the extent that inflation is driven by tightness in the labor market and a labor shortage, that may persist for some period of time. So again, I don't think that we'll see inflation at 5-6% for more than that maybe short-term time frame, but it may be above 2% or above the Fed's 2% target for sort of that medium to longer-term time frame. How that plays into the markets, that certainly affects the fixed income environment. What we're looking at here on slide 28, the top half is the yield curve. This is just the rate of interest that you are paid for a government bond. And as we talked about, that sort of 10-year government bond, which is that benchmark or bellwether instrument, is right around kind of 1.6, 1.7 today. Interest rates are higher than they were a year ago, and we think the expectations are to continue moving higher going forward. This sort of has two different impacts on the way we think about portfolios. In the short term, as interest rates increase, that creates a negative return for fixed income instruments. So it just creates an even tougher environment for fixed income investing, is that we're likely to see some negative returns for bonds. But if this is sustained for some period of time and we get back to, quote unquote, normal over the next few years, and the 10-year Treasury is back to 3 or 4 or even 5%, that's an environment where we can think about adding more fixed income securities into the portfolio because hopefully they'll pay a higher level of interest. So, a couple of different ways to think about interest rates moving up. Certainly, the Fed has pledged to keep interest rates at zero for some period of time. We are probably expecting that first interest rate increase from the Federal Reserve sometime in early 2023. Or maybe even late 2022. So it seems like we'll be in this zero interest rate environment, at least for the very short term, for another 9 to 12 months. But then from there, if we look at what the futures market is telling us, it's that short-term interest rates are likely to move up from 0 to around 1.5. So why this matters, if you think about just your run-of-the-mill checking account or savings account that you have at a local bank, a couple years ago, pre-COVID, you were starting to see a higher level of interest being paid on short-term cash. You could earn maybe 1.25%. Today, that's 0. That's been 0 for a while. It's probably still going to be 0 for a while, but likely at some point in the next couple of years, we'll see interest rates move up, and then we can think about earning a slightly higher rate of return on cash instruments. The longer term maturities, if we think about, the 30-year bond, which is linked to mortgage rates, the 30-year fixed mortgage, that's where we don't expect a whole lot of movement. And those are primarily driven by overall economic growth, overall demographics. And I think the growth that we're expected to see in the next year or two coming out of COVID, I don't think anyone is expecting to persist. So the long-term growth rate for the U.S. economy is probably closer to 2.5 or 3%. And that's a number we think will resume once we're sort of on the other side of these COVID-induced changes that we've seen in the economy. I don't think anyone thinks the U.S. economy will continue to grow at 6.5% going forward. So probably more interest rate increases on the short end of the yield curve, not so much maybe on the longer end. How this impacts us and how this impacts returns for the overall portfolio, we've already started to see. So if we look at just the top line here, the Bloomberg BarCap Aggregate Index, that is a measure of high quality investment grade fixed income bonds in the US. And we've seen the returns in this part of the market have really not been all that good. So year to date, this index is down 1.5%. And we think about, fixed income, that's the anchor of the portfolio. We kind of rely on fixed income for cash flows. And to see a negative return from the fixed income portfolio certainly, dings our overall expectations going forward. It's a good reminder as well that what is a bad environment for fixed income looks nothing like a bad environment for equities. So only being down 1.5%, it's actually a sort of a tough time frame for fixed income, but that can happen in a couple hours in the stock market. So it's again a good reminder that volatility between the two asset classes is quite different. If we look out to the long-term returns, so over the last 10 years, fixed income, high quality fixed income has returned about 3%. And that number is probably almost twice as high as what we expect over the next 10 years. I think our asset allocation model had fixed income at 1.9. So over the next 10, we don't expect even this 3% return to be sort of duplicated. We're probably going to see more kind of quarters, months, and years of pretty flat, if not negative returns from the high quality part of the bond market. Sort of switching gears and sort of how the bond market relates to equities. We've seen the Fed absolutely explode the size of their balance sheet to try to combat this crisis, to help individuals and help businesses get to the other side, hopefully, of this pandemic. So the size of the Federal Reserve's balance sheet is the gray line. We see that kind of absolutely skyrocket during the beginning portions of the pandemic. And then the blue line is the total return for the S&P 500, so equity returns. And there certainly is a link between the two. With more money kind of flooding into the economy, more assets start to find their way into the equity market, boosting stock prices across the board. And I think the concern today is that as the Fed thinks about kind of putting the brakes on the stimulus, if not starting to dial back some of that stimulus, can equities continue to return the rates of that they've been producing without that sort of stimulus from the Federal Reserve or from other central banks around the globe? And that's the question that remains to be seen. Now, coming out of the 2008 financial crisis, we saw the balance sheet start to taper down. The Fed was working down their exposure in the market, and equities continue to move up sort of regardless. Now, there was some choppiness there, but they continue to move up and be a nice returning asset class. So the question is, today, as the Fed thinks about tapering down the stimulus going forward, will equities continue to produce the returns that they've been over the last couple of years? And I think our expectation is probably not. The sort of 15, 20, 25% returns annually we've been seeing in equities, we think are likely to come down. And this is sort of seen in earnings growth. So if we look at earnings across the S&P 500, they've been remarkably good over the last few quarters. Now, the comparison level to early 2021 is certainly a low comparison. But here in the second quarter of 2021, we saw pretty robust earnings growth, pretty robust revenue, net income. Companies across the board are pretty healthy. That has been reflected in stock prices, and we think those numbers are likely to also come down going forward as some of the sort of pandemic-induced demand starts to subside over the next couple of quarters. As far as returns go in the market, we've seen really strong returns over the last decade. So if we look at equity indexes, again, the S&P 500 here, about halfway down the page, over the last 10 years has been compounding at a rate of return of 16.6 per year. That's probably more than twice the long-term average. Certainly, it's more than twice than our 10-year expectations. And this is a number that we think, while it would be great if it did persist, we don't think it is likely to. So these numbers are likely to come back down to earth, as that sort of 17% per year is an unlikely expectation for equities going forward. We saw a little bit of volatility creep into the markets in the month of September. So the equity market was down 4.7% for the month. That is not unusual. We kind of looked at returns by month across the calendar year, going back to 1927, the inception of the S&P 500. And every month, with the exception of September, has average returns that are positive. September is the one month where the average returns are a little bit are negative. So it's just interesting to see that for whatever reason, there are some quirks throughout the calendar, and September tends to be a more often than not as a negative month, and we saw that again here in 2021. Now, thankfully for portfolios, for us, for our clients, those numbers have snapped back here in October. We've seen October markets be back to their all-time highs, but definitely a little bit of a pullback in the month of September, which is to be expected. So I think on average, if we look across long-term markets, we see about 3 5% drawdowns every year. We see a 10% drawdown maybe every couple years, and a 20% drawdown every 5 or 6 years. What we're looking at on this chart is the calendar year return in the orange boxes for the S&P 500, which pretty consistently going back to 1990 is positive, although we certainly see some big negative years like 2008, 2001, and 2002. But I think this chart gives a good reminder that even in positive years, so even in years like a 2010, where the market returns double digits, at one point during the year, the green diamond represents the biggest drawdown that the index had. So in 2010, at one point during the year, the portfolio or equities were down about 15%, despite the fact that they finished the year up 15%. This year, if we go all the way to the right-hand side of the chart, we don't really see a big drawdown for the index. September was the biggest drawdown we have at around 5%. And I think our thought is that is unusual, and we should prepare ourselves, prepare our clients, prepare our portfolios for more volatility and more drawdowns, because it has been the historical average. In the last couple of years, we just haven't seen that much volatility, with the exception of the first quarter of 2020 with the start of the pandemic, when we had a pretty significant downturn. But historically, this is a pretty normal process for markets. This is what allows us to earn that equity premium, is the ability to tolerate the risk and tolerate the volatility month to month, kind of quarter to quarter. So if we think about returns outside the U.S., obviously we are U.S.-centric investors. All the headlines are created here at home, and we kind of know what's happening in our markets maybe better than where we know what's happening in the rest of the world. But we can't ignore the fact that almost half of global market cap is traded outside of the U.S., and we have investments outside the U.S. If we think about returns in that part of the world, they certainly have not been as good as the returns here at home. So if we look at the third index here, the MSCI EAFE, that stands for Europe, Australia, and the Far East. It's a developed market benchmark. Over the last 10 years, the returns have been 8.1. We just saw the returns for the U.S. benchmarks at around 16%. So the non-U.S. market has returned about half of what the U.S. market has over the last decade. Going down a couple lines to the emerging market index, this is where we expect to see a lot of growth, a lot of volatility, but really good sort of demographic stories as places like China and India begin to develop their economies. And here, the emerging market part of the world has performed even lower, 6.1% over the last 10 years, with some pretty good volatility here in the last couple of months. So the takeaway here is that the return environment outside of the U.S. has been good, but not nearly as good as the returns here at home, as the best companies and the best performing companies continue to be based in the US. And it's really been a large cap tech story that's been driving growth, with names like Google, Amazon, Facebook, and now a company like Tesla driving returns for indexes here at home. It's hard to think about the rest of the world as a sort of homogenous group. There are, obviously a lot of different countries with different political regimes, different demographic stories, and more recently, a different sort of handling of the COVID crisis. Some countries have done a much better job managing the pandemic than others, and that has been sort of reflected in returns. And if you look at, just returns here on a year-to-date basis, we think of Russia, India, Brazil, and China as 4 of the largest emerging market economies, and their returns so far this year could not be any different. Russia and India on the positive side of the ledger, Brazil and China on the negative side of the ledger, and all for very differing reasons. China has had some concerns around the private markets and the ability for private companies to maintain profits within their society. Brazil has had a really tough time managing through the pandemic, and certainly has had some energy issues. And then on the other side of the coin, Russia and India have managed things quite well and maintained pretty good balance sheets at the overall economic level. So we tend to think of the world here as U.S. investors as sort of a single group of the rest of the world. But the truth of the matter is there's a lot of different stories happening across the world, and it really depends on where you're invested within these economies, within sectors, and at the company level outside of the U.S. Here's a longer dated chart of performance between the U.S. and the non-U.S. market. This is something that tends to move in something that looks a little bit like a sine wave. And really from the beginning of the tech bubble bursting to the financial crisis, the non-U.S. market was doing quite a bit better than our market here at home. Over the last 10 years, the U.S. market has been doing quite a bit better. And I think this is a reminder for us that even though non-U.S. returns haven't been as good, we can't sort of give up on global diversification because the ability to time a chart like this really doesn't exist. So we want to have diversified investments across the globe to sort of make sure that when this chart flips, we've got investments outside that can benefit the portfolio and keep things moving, even if our U.S. market here at home hits a little bit of a roadblock. So I've kind of covered the main asset classes: fixed income, U.S. equities, non-U.S. equities. But certainly there's a good amount of this portfolio and all of our clients' portfolios that are invested in alternative investments. And I use that term broadly because I'm using it to mean, really anything outside of stocks and bonds. Traditionally, alternative investments are probably defined as hedge funds, but I guess I'm using it as a term to include things like real estate, things like infrastructure, private equity, really anything that's outside of your traditional stock and bond portfolio. And in a lot of cases, that alternative piece can be about a quarter, if not maybe 30% of the overall portfolio. Real estate is an area where the Community Foundation has a pretty decent size investment. Real estate is about 10% of the overall market capitalization of investable assets. And in the Community Foundation portfolio, it's around 8%. So we hold real estate in a similar allocation that we do maybe what a global market cap portfolio would suggest. And real estate is one of those markets that is undergoing a dramatic shift because of COVID. This chart shows transaction volume and price growth for the various segments of commercial real estate. The retail segment, the office segment, apartments, and industrial buildings. So not residential real estate, but the four sort of main food groups of commercial real estate. And those four areas have incredibly different outlooks at this point in time. And this is sort of, one of those things that gets us to change our long-term thinking. If we think about those four various subgroups, the retail segment of the market we know has been challenged for some period of time. There has been a pretty significant shift from online brick and mortar retail to online shopping, and that's been underway for the last decade, only accelerated by COVID. So high quality retail, like places here in Chicago on Michigan Avenue, are not worth what they once were, and it's a tough segment of the real estate market to make money. Conversely, the office space, that's another one. Pre-pandemic, no one had any major concerns about high quality central business district offices like the building I'm sitting in here in Chicago. But the pandemic changed the way that we live and work. And the question has become today, what are these big office buildings in cities around the country worth? On the flip side, the industrial part of the market has been absolutely on fire. Pretty much anywhere you look, Amazon and other online retailers are building warehouses to store their goods, to get them to you next day shipping or same day shipping. So anyone with industrial exposure has been doing really, really well. And the same story is true for multifamily apartments. With the sort of lack of single family housing that has been built over the last number of years, pricing within the multifamily space has been sort of off to the races and doing quite well. So this is an example of just one of the things that we have to think about outside the traditional stock bond portfolio that can drive returns, and certainly has changed over the last couple of quarters as it relates to COVID. Another area of the portfolio, and this is one that probably doesn't get all that much discussion in normal times, is infrastructure. Infrastructure has been a buzzword over the last probably couple of quarters due to what's going on in Washington with them trying to pass a comprehensive infrastructure bill. And certainly, do we need better infrastructure here at home? I think anyone that's taken the public transit here in Chicago or traversed a lot of our roadways knows that we could all probably use some improvement to airports and bridges and railways. And infrastructure is an area we have investments in the portfolio. Again, not one that makes headlines all that often, but something that we're monitoring and thinking about, and certainly an asset class that we think has some tailwinds, should this government package get through and we see more spending in the infrastructure space. Outside of that, a big area of focus for us is private markets, both private equity and private debt. So these are illiquid parts of the portfolio, but because of that illiquidity, they're expected to return rates of return in excess of what the public markets do. So if we think about private equity, for example, we want to see private equity portfolios earn maybe 2 to 4 percentage points above what the public markets do. That's the illiquidity premium. And in kind of what we show on this chart here is the spread between top and bottom performing private equity managers over the last kind of 20 or 30 years. And here's an asset class where manager selection is crucial. Getting the right private equity investments is really important, as it can have a dramatic influence on returns, unlike what we see in the public markets, where a lot of the managers tend to concentrate in the middle. They don't have the same sort of price swings that the private markets do. So we spend a lot of time thinking about private equity, thinking about how to build a private equity program at the community foundation. And this is something that we expect to drive returns going forward. It has been a strange environment for private equity over the last couple of years. We've seen, the interest in the asset class really only increase over the last decade, but COVID put a little bit of a damper on that, in the sense that a lot of private equity due diligence or investments are in smaller companies, and that sort of due diligence or research effort always took place in person. Well, all of a sudden, the private equity world had to adapt to conducting due diligence on small businesses over mediums like Teams or Zoom, and not getting together in person. So we saw transaction volume dip accordingly in 2020. Not nearly as much transaction activity occurred within the private equity marketplace, but we do expect that to be on a better track here in 2021. Is that we've almost already eclipsed 2020 transaction activity in only the first half of 2021. So the point is, this is a popular asset class. This is an asset class that we have a pretty significant investment in, and this is one that a lot of investors are expecting to drive returns going forward. We see a lot of interest in the private equity market at the large end. So at a place like Blackstone, or a place like Apollo that's doing, or KKR, doing massive deals. We generally try to avoid that part of the market and prefer the smaller end of the market, where we don't see quite as much competition, quite as much pricing appreciation at some of the underlying companies. And this is where we think the best returns are likely to be had. I'll finish on kind of this last slide. So one of the things our research team puts together is just sort of an overall monitor as to where we think different asset classes, their attractiveness level stands. Things are always moving, things are always changing, but we build diversified portfolios to kind of persist for the long term. And I think at the moment, we've seen really good returns for the better part of the last decade. We've seen really good returns for the last couple of years, despite what's gone on for the pandemic and for COVID. And we think that can persist for some period of time. Now, we don't think it'll persist indefinitely. We don't think equities can continue to compound at 16 or 17% per year. But I think there's a lot of tailwinds in the market today. So we can, probably think about pretty decent returns here in the short term. But I do think those numbers and the expectations are going to come down going forward, given where our interest rate environment is and given where returns have been in the past. So I'll wrap it up there. That's about all I had prepared. I think we have probably a few minutes for questions. Happy to take any of those. But overall, hopefully you guys, found this helpful and at least a little bit insightful as to the way we think about portfolios at Marquette, the work that we're doing with the investment committee to kind of, keep the Start Community Foundation on good footing and keep the assets growing into the future.
Thank you, Chris. That was excellent. We do have a couple questions that came through, and I know we had some when some of the participants registered as well. And I think it's interesting for the, the attendees to realize, everything we just went through today is pretty much just the tip of the iceberg of what the foundation goes through with you and the investment review committee on a quarterly basis. And then, of course, we're in touch daily and weekly on the portfolio as well. So, I always like to remind our fund holders how closely we monitor the portfolio and the partnership with the foundation in Marquette. And, we certainly keep our hand on the pulse of everything going on. So thank you for all your work on behalf of the foundation and that excellent presentation. One of the questions we did have, and I do think you ended up answering it in more detail. It's a two-part question, and it says, you mentioned the 60-40 equity fixed income allocation. Is that the current goal? And I think probably slide 15, I think you had a nice snapshot of our strategic asset allocation that clearly shows the different asset classes that we're invested in. And so I don't know if you want to speak to that. And then a follow-up to that question is, since SCF is so large and has an infinite projected lifespan, why not more equity, 70-30? And I do think you touched on that as well with Marquette's thoughts that we're probably not going to see the returns on the equity side in the future like we've seen in the past. So I don't know if there's anything else you want to add to those few questions there.
Yeah, no, those are both really good questions, and those those are kind of at the core of the way we think about building portfolios. So if you look at the overall allocation, the 40% that's in that classic 60-40 portfolio construction that historically was in fixed income in our portfolio today is down to 13%. And the reason that number is so low is, again, the interest rate environment. We just don't expect to earn much in the way of rate of return. So we have about 8% in high quality core fixed income that will hopefully, get the portfolio through a protracted downturn and allow us to continue to spend. But we don't really want to keep any more than that because we know it's not going to drive returns going forward. About 55% of the portfolio is invested in the public equity markets, and then another 10% invested in the private equity market. So equity exposure is around 70%, not quite. It's around maybe 65, but it's close to 70. And then we think about things like alternatives and the real estate and infrastructure markets as somewhere between stocks and bonds. They probably won't deliver the same return as the equity market over time, but they also don't contain the same amount of risk. And that just helps smooth volatility out from quarter to quarter. We know this portfolio has to generate cash and has to produce cash. And if we didn't have sort of that cash flow demand on the portfolio, we could be maybe even more aggressive than we are today. But I think, given the spending needs on the portfolio, we think we've got things probably tuned up about as aggressive as we can be. And again, the goal is long term to get the portfolio to grow and continue to spend.
Very good, thank you. And maybe one more question here that came in during the registration process. And again, I think you touched on this, but maybe we could speak a little bit more to it. The question was, where is inflation headed? And I know you said in the short term, we're probably going to see this high inflation environment, and we do anticipate that to eventually come down, but maybe you can talk a little bit more then around the drivers of inflation, because you mentioned some of the commodity prices have started to come down, the lumber and that sort of thing. But it seems to me that the energy prices right now, one of the primary concerns around inflation. What's Marquette's thoughts there?
Yeah, so inflation's a tricky one, and the reason is it doesn't necessarily mean the same thing to everyone. The way that it's measured for the consumer price index is a predefined basket of goods, but we all don't spend our money in the same way. So if you think about, if you've got 3 or 4 kids in college, you probably for the last 10 years have felt maybe more inflation than anybody else that wouldn't have kids in college, because higher education has been inflating dramatically over the long-term time frame. Whereas if you spend a lot of your money on electronics, you wouldn't feel a lot of inflation because the cost of TVs or high quality electronics has come down dramatically. So it's a tough thing to measure because it doesn't mean the same thing to the same people. But certainly energy is a big one. Energy has a big impact. That's maybe a little bit overstated because of what energy pricing did in 2020. We saw oil prices go negative for a while. So the year-over-year change looks maybe more dramatic than it is, but certainly energy prices on the rise. And that's something, if you drive a car, you kind of pay at the pump. The question as to where inflation is going, that's where this forecasted box, the expectation is for it to come back down to maybe a more elevated level than it used to be, but somewhat normal. But that's just forecasted. You know, we could certainly see this line continue to trend up, and it would become more and more painful for portfolios and us all as consumers. So I think the baseline assumption here is that it does go back down to maybe that 2.5–3% level. But even that is maybe twice as high as it was in the pre-COVID environment.
All righty. Well, Chris, thank you again. We're coming up right on 10 o'clock. So again, I thank you for your time and really for everybody on the webinar today. I want to personally thank you for joining. I know we all have very busy schedules, but we hope you found value in today's presentation. And just a reminder, it has been recorded. It'll be available within the next couple of days on the Start Community Foundation's YouTube channel. So certainly feel free to access that, share it with colleagues and friends. And thank you again, and enjoy the rest of your day, everybody. Take care. Thanks, Chris.